Hello and welcome to another webinar from ING's global research team. I'm James Smith, an economist based here in London. Now, back in June, ECB boss Christine Lagarde told us that the central bank was, quote, in a good place, and it's easy to see why. Inflation's at 2%, rates have been cut from 4% to 2% as well. Growth's not too bad. What's not to like? What could possibly go wrong? Well, when it comes to Europe, as we know, the answer is often quite a lot. Now, we're doing things a little bit differently this week. We're going to look at our key calls for the Europe and Euro financial markets, and then we're going to pick it all apart and see what could go wrong with it. Before we get to that, though, I want to know what you think. We've got a poll for you. When do you think the ECB will cut rates again? Will it be tomorrow? Will it be September, October, December, next year? Or do you think the ECB is done? The next move is a rate hike. Put it in the poll and we'll come back to those results in a minute. Now, I've got two great speakers for us today to talk through all of this. I've got Carsten Brzeski, who's our global head of macro, font of knowledge on the ECB. Welcome, Carsten. And we've got Michiel Tukker, who's our senior European rate strategist, experts on bonds, swaps, money markets, everything in between. Now, let's start with a simple question, guys. What's your key call for the next 6 to 12 months? Carsten, why don't we start with you?
Yeah, key call is one more rate cut by the ECB after the September meeting. Why? Because there is still a big risk of inflation continuing to undershoot, and the ECB can simply afford to continue cutting rates. 12-month, James, as you asked for it, over 12-month, I think we will start talking about a rate hike. End of 2026 could be the moment for a first ECB rate hike.
Very interesting. Thanks, Carsten. And what about you, Michiel?
My key call would be that swap rates could continue to grind higher, whereby the 10-year swap rate could gradually move from the current 2.6%, touching the 3% by the end of 2026.
Good stuff. So, Carsten, I mean, you touched on it there. You're expecting another rate cut from the ECB because there's sort of risks in the pipeline. But to be honest, like, why are we even talking about a rate cut? Because sort of superficially, at least, you look at the ECB, inflation's at 2%. It's been there for like 6 months. We're at the neutral rate, 2%. This is like the dream for central banks, right? This is like what happens in the long run, which you never normally get to. So yeah, like why are we even talking about this?
Yeah, you're right, James, and you mentioned the June meeting, and which was an important one because there was a big change also when you look at the ECB's own forecast, because that was the moment in which they brought forward the timing of their inflation profile. So for a long while, the ECB had always expected inflation in their projections to only dive below 2% in the third or fourth quarter of 2026. So now in June, we had for the first time actually diving below 2% already this year. And that was a significant shift. And, Christine Lagarde, you mentioned it, said the ECB is in a good place. So why leaving this good place? Reason one is that I think, on the back of a stronger euro, there is still the risk that inflation will surprise to the downside, so that we would get a bit of more of an undershooting of inflation till September, that when September comes and we have a new round of forecasts, the ECB will be forced again to slightly tweak its inflation forecast to the downside, and that is then the moment at which they could cut one more. The other reason, of course, is, and that is something hardly anyone dares to predict anymore, is trade and Trump. Depending a little bit on what's happening over the next couple of days until August 1st, if a trade or tariff escalation clearly would mean there's a lot of room for the ECB to cut. But even if we get a deal, and this deal will be probably worse for Europe than what we currently anticipated. So higher tariffs than our assumed 10% universal tariff and a bit of sectoral tariffs. So anything north of these 10% universal tariffs for Europe will mean downside risks to the eurozone growth outlook, and hence a reason for the ECB to cut rates once again in September.
Yeah, thanks, Carsten. So, I mean, we've got that 1st of August deadline, as you say, so a lot can happen before September. I mean, is it fair to say then that tomorrow's meeting, the ECB will basically just say, well, we don't know what's going to happen next, anything could happen? Or do you think they might sort of try and move the dial a bit closer to another rate cut?
I think to some extent, Trump's letter even helped, because when you look back a couple of weeks ago, before we had Donald Trump's love letters, there was a lot of talk also at the ECB about the strength of the euro, and we even had Vice President de Guindos, doing what never should be done by a central banker, namely coming up with a level. And de Guindos said that once the euro dollar is at 120, this would complicate the ECB's life. Well, mistake number one for a central banker. But anyhow, it showed that I think back then the ECB was in a discussion on whether they might have to continue cutting already now tomorrow. With the uncertainty coming from trade, there is a very good reason for the ECB to wait and to do anything tomorrow. That is really clear. Should they give any forward guidance? Also, look back, we had an update on a new assessment of the ECB's monetary policy strategy, and I think the ECB has simply dumped this tool of forward guidance. There is no reason to give any forward guidance right now, given this high level of uncertainty. I think if Christine Lagarde wants to give any guidance, she might want to do some tweaks to the good place, because I think that is what every good journalist should ask her tomorrow, whether she still thinks that the ECB is in a good place or whether the ECB's good place has become a bit worse. If she opens the door there, that is as much forward guidance as we can get. But it could also very well be that tomorrow's press conference is something that we rather enjoy with a cocktail glass in our hand, and hardly anything will happen in terms of communication.
ECB with a cocktail sounds lovely, Carsten. I forgot to mention at the beginning, if you do have any questions, do put them into the chat, into the questions box. We will come back to them at the end, or if you agree or disagree as well with anything we're saying. Be interested to know what you think. But speaking of that, let's check in with our poll that we did just now. Very interesting, actually, Carsten. About 40% agree with you with that September cut, but very much 50-50 really between then or I guess later this year. A few thinking later on, very few actually thinking that the ECB won't cut again at all. So that's kind of interesting. I suppose, Michiel, just in a few words, how does that compare to market pricing?
Now, what you see with market pricing is that so far the ECB has orchestrated every rate cut very well in advance. So we can also look at the trading ranges where markets have been, okay, maybe the ECB would have cut to 1.75, maybe 1.5, maybe to 2 as a landing zone, but very little movement elsewise. And especially the past few months, markets have been very much convinced that 1.75% is going to be the landing zone. That means one more cut. However, markets are also in a bit, I think, as the poll also shows, reflects it quite well, still in dubio whether it's going to be the September or the December cuts. And I think markets are in a similar position as well. There is a lot of uncertainty. It's very difficult to decide. They'll simply need a bit more data, a clarity on a trade deal before they will show a bit more volatility. And until then, I think they'll just stick to that 1.75 with a 50% chance on either date.
Yeah, and I suppose if we're saying that the ECB is going to cut in September and markets aren't fully pricing that, I suppose you could make the case for a bit of a modest dovish repricing this summer. But I suppose we also have to talk about the US, right? Obviously that's the dominant story right now. And we have that view that this summer is going to be very hot for US inflation. We've not seen a lot of it so far, but we are going to see more of it through this summer. And that's going to mean that the Fed won't be able to cut in September, and you get a bit of a hawkish repricing at the Fed. So I suppose with that backdrop, if that does happen, does that pull euro rates actually higher? What's the correlations these days between Europe and the US?
Yeah, absolutely right. Like for the Fed pricing, it's a completely different story. Markets are bouncing up and down. There are no trading ranges identifiable. But luckily, to understand the euro picture, it's very clear that markets have separated from pricing on Fed cutting expectations. So, for example, if you look at the 2-year rates, so the 2-year swap rate, and look at the 2-year US Treasury yield, you can see before the elections, those moved entirely in tandem, as in markets would follow where would the Fed go. That's also where markets would expect the ECB to go. After the elections, that correlation completely broke down. And we're talking about quite a big shift. So we had a correlation of about 0.6 or 40% of the daily moves in the 2-year euro swap rate were driven by US rate moves. And that dropped to 2%. So practically zero correlation thereafter. So that does give markets the flexibility to also completely price the path of the ECB independent of what the Fed will eventually be doing.
Yeah, interesting. Thanks a lot, Michiel. Right, let's start tearing this all apart and look at what can go wrong. We've already touched on some of this, right, Carsten? So tariffs is the most obvious thing. I mean, you talked about a deal earlier. I mean, I think you kind of hinted at the fact that, I don't know, dare I say it, the Japan deal is maybe a bit of a template for Europe in the sense of, maybe that baseline tariff goes up a little bit. I suppose the question is, and there's a question that's already been asked about this from our audience, if tariffs do go up to 15 or 20%, I mean, does that start to become a bigger issue for the eurozone economy? Because you could argue at the moment that, yes, we've got this 10% baseline tariff. Yes, there's lots of uncertainty, but maybe the eurozone economy can kind of weather that. Does that become more problematic if that baseline tariff goes up?
Well, definitely. We use this rule of thumb based on some estimates that that a across the board U.S. tariff on European goods of 20% would lower eurozone GDP growth by 0.3 percentage points. This gives you some idea of how much the damage could be, and we also know the longer these tariffs are in place. So if this would be for good, it means that at least according to these estimates, the harm will increase over time. So yes, this is not a matter of life and death, but clearly we currently we also consensus expects Eurozone growth to be somewhere between 0.5 and 1% this year, shaving off 0.3 percentage points obviously shows you we would move closer to stagnation once again. On top of that, and that is always harder to model and to quantify, we have this long period of uncertainty that we've had so far, which will also weigh on economic activity in Europe. And the third point would then also mean if you just remember, James, what we had in November, we all thought that these expected U.S. economic policies would make the U.S. economy more attractive and would also bring investments out of Europe into the US. Well, if this was now to happen, once we have any kind of trade deal, I think the longer term damage would even be larger for the Eurozone. Well, of course, on the other hand, we have all kind of initiatives currently going on in Europe that are trying to keep and actually to increase investments in Europe. But so tariffs will not be the end of the world. They will undermine Eurozone growth. They will be, in my view, the trigger for the ECB to continue then cutting interest rates at least once more in September. And the longer term damage is currently extremely hard to quantify because, in my view, we're still seeing really these structural shifts between the US and the European economy.
Yeah, exactly. And Michiel, let's talk about what this means for financial markets, because I mean, I'm going to say it from my perspective, I really struggle to see Europe's tariff going dramatically higher on the 1st of August. I can certainly buy into what Carsten's been saying about does that baseline tariff go up under a deal, but a sort of more extreme sort of tail risk scenario to me feels unlikely. I'm guessing that's also the view in markets, right? It feels like financial markets are becoming less sensitive to this stuff. So I suppose the question is, if we do get a deal between the EU and the US over the next week or so, is that already in the price? How much upside potential is there for euro rates?
Yeah, markets seem already quite positive about a deal finding place, and that we can see that rates have already drifted a lot higher since Liberation Day. Having said that, we're not back at the levels from before Liberation Day. So that was just after the big German spending announcements. So that would give room, if that would be a bit of an anchor of where we could go if a trade deal is signed with reasonable tariff amounts, then we could easily see another 20 basis points higher for 10-year swap rates. And I think that market move, you could already taste a bit today because we have the Japanese deal being signed, and that really showed that optimism does give a bit of a boost to euro rates, does bring up fair number of basis points immediately. So I do expect also when there is a trade deal being signed, it's not fully priced in yet, and we will see a bump higher in 10-year swap rates.
Yeah, thanks a lot, Michiel. speaking of tariffs, I suppose one of the risks, right, is if tariffs really come back in a meaningful way and you get sort of Liberation Day 2.0, you get that Sell America narrative coming back into markets. And then, the dollar gets a lot weaker again. So that comes back to that euro story, Carsten. I suppose, here's a sort of scenario for you. We talk a lot about 120. There's actually a question we've got here. Why do you think the ECB, so to Guindos, specifically mentioning 120 as a level in euro dollar? But let's take it even further than that, because our FX team have some nice scenarios on this. And as they say, if we're going to get to say like 125, what you really need to see is very dovish Fed. So maybe Powell gets fired, but also this sort of real sort of tariff Liberation Day narrative coming in again. So let's sort of take that scenario. Is that actually a big deal for the ECB, Carsten? I mean, you can make the argument that for inflation, at least, we've seen all sorts of shocks over the last few years. Maybe this wouldn't be as big a one. What does the ECB actually do about it if we get to those sort of levels?
Yeah, well, regarding the Windows, I think he simply forgot to read the Central Bankers Manual 1.0. Never comment on a specific level of the exchange rate. Is the stronger euro an issue for the ECB? Well, we know the official reaction would always be it is not a target, it's not a policy goal for the ECB, but the ECB looks at it as a transmission mechanism, and that is rightly so. So the stronger the euro gets, and then there is no certain level, but the stronger the euro gets, the more downward pressure there will be on inflation. That is a pretty mechanical reaction according to the ECB's models. And then the question for the ECB will be: should we react to that, or is it just a temporary undershooting? Which would then also bring back the question of would the ECB ever dare again using the word transitory? Well, also coming back to this policy assessment that they had a couple of weeks ago, it read a little bit as if the ECB would never ever want to use the word transitory again, but we don't know. So just to put this a little bit into numbers, and we have had already a strengthening of the euro so far. So where we are right now would not make a big difference. But if we were to go to, let's say, from 117, 116 to 120, if we also were to see the trade weighted exchange rate also to increase by another 5 or even 10%, that would clearly then bring more downward pressure on inflation, and could be another argument for the ECB to continue cutting interest rates. But as so often, there is a big but. This would not be aimed at reversing the trend, because we all know a central bank will not really be able to reverse a trend in its currency unless it also goes for FX interventions, unless we have coordinated central bank interventions, and all of this is not going to happen. So the ECB will only focus on the impact the stronger euro will have on growth and inflation, and would then react accordingly.
Thanks, Carsten. We've actually got another question as well, which is how do you see euro dollar over the next few months? It's worth saying, actually, we talk about these scenarios. Our base case is actually in the very near term, euro dollar actually goes down more towards 115 before creeping up again. But do take a look at our team's forecasts for that. We haven't got time to cover them in too much detail today. They've got some lovely FX talking publications on our website, so have a look at that. Let's go in a different direction, Carsten. Let's talk about rate hikes. You kind of teased it out at the beginning that the ECB could could hike rates. I need to get used to saying hike again. Could hike rates in 2026. That's a nice segue, isn't it, into the German fiscal story, because I'm guessing that plays into it. Just very, very quickly, was a big story earlier this year. We had the big announcements on infrastructure and defence. Have we had any more details on that over the last couple of months?
Yeah, we had, and I think that is the impressive thing about this new German government. It doesn't mess up. So they are delivering on their promises. So a couple of weeks ago, we had the budget plans for this year, next year, and 27. And then we see that they're now really implementing the fiscal stimulus announced already in March, and then once again when we had the coalition agreement. So we will get the fiscal stimulus. It will start already more as of now, because in the second half of this year, there will be faster depreciations for certain investments of companies. So that should already help the economy. And then come 26, come 27, we will finally get these additional investments in infrastructure and also in defense. And then getting back to the ECB, this means stress testing our call that even though there are probably more downside risks to growth and inflation in the near term, in the longer term, in the medium term, there are more upward risks to both growth and inflation. And the German fiscal stimulus is clearly one of the reasons for that. We also know it's not only about Germany. We know that there are always nice spillover effects from German fiscal stimulus on the rest of the eurozone. So this also becomes a full eurozone story. And and that is, in my view, also the reason why the ECB, would not cut aggressively this year, because they know that come 2026 there will be the more upward pressure on inflation, there will be more upward pressure on growth, so they would have to hike already in 26 again. So in our base case scenario, one rate cut this year, and then going into 2026, as soon as this fiscal stimulus really starts to push growth, and there will be new pockets of inflation will also show up, the ECB would at least consider bringing the interest rate back to what they think is neutral. That would be 2.0. Or if we even were to see signs of potential overheating, hard to imagine that we could get something like an overheating in the current situation, but in pockets of inflation, then I could see the ECB even going above 2%, not in 26, but then in 2027.
Okay, Carsten, let me play devil's advocate with the German fiscal story a little bit, right? Because we're talking about infrastructure, which we know is great for the economy, right? Because it boosts the supply potential, it's great for growth. But, I mean, maybe this is just a cynical Brit talking, right? The infrastructure takes ages, doesn't it? I mean, at least here in Britain, the government here as well is talking about doing a lot of infrastructure, but then you've got to contend with the planning system. That takes years. You've got to find workers to build stuff. I suppose like the obvious question is there a risk that in 2026, we're all talking about this as a big story and it just doesn't show up?
Well, James, from the cynical German to the cynical Brit, obviously speaking, Germany does not really have a strong track record in implementing big infrastructure projects recently. So whether it is the airport in Berlin, whether it is the central station in Stuttgart, or other big projects in Hamburg, indeed, they have always been delayed. Cost too much money and have not really been a success factor. I think what is remarkable that also this week we had a summit in Berlin between the government and some corporate leaders, and the corporate leaders also promised to add some private sector investments, to the whole story. Symbolic, but it shows that the government knows that it will have to deliver. The fact that also big corporates are now also kind of chipping in means that also the corporates are willing to support this whole story. So as much as I sympathize with with some cynical assessment here of the situation, I would currently still opt for a scenario in which we will see that this infrastructure spending will lead to some growth. Does it also mean that there will be structural reforms, that Germany will again be the growth engine of competitiveness and of European growth? No, it doesn't mean that. But if you put so much money on the table, both public and private sector money, I still think, talking about bold calls, that next year we will see the German economy outperforming the rest of Europe.
Okay, let's hope you're right, Carsten. All right, cynical Brit, cynical German. Michiel, what about financial markets? Cynical investors as well? Obviously, this was like a big story in Q1, wasn't it? I mean, is the German fiscal story in the price?
Yes, definitely, James. Like if you look at market pricing on the five-year real forwards as a sort of a measure where the long-term growth outlook is from rates, you can see a big jump happened on the day of the German spending announcements. And that jump really held, even though we had Liberation Day, even though we had a lot of setbacks as well in terms of market sentiment. There is a 50 basis points repricing of that long-term real rate component. So that really suggests that markets are expecting this to happen and also see this as the primary driver rather than, for example, the damage done by Trump's trade policies at the moment or other headwinds that we're facing at global politics. But that, of course, also poses the downside risk, right, to the rates outlook. If markets do lose that faith that fiscal spending story will actually materialize, then we could also see quite a sharp reversal again of, for example, 10-year swap rates another 50 basis points lower. So as long as that confidence is there, that we do see some form of fiscal spending that can have a structural impact on our growth outlook, then we have higher long rates to come.
Thanks, Michiel. And we're going to come to your scenarios in a second. I know you've got some nice sort of thoughts on what the upside and the downside is for Euro swap rates. Before we do that, I want to know what you guys think about this. We've got another question for you. What is the most important driver of Euro rates in the second half of 2025 going to be? Is it Eurozone inflation surprises? Is it Eurozone growth surprises? Is it actually what's going on in the US, large US interest rate moves? Or is it a deterioration in global risk sentiment, maybe linked to geopolitics? Let us know what you think. Michiel, let's talk about your upside and your downside scenarios. When you wrap together everything we've talked about so far, what does that look like in terms of levels?
Yeah, so first let's think about the downside scenario. So that would be an ECB that would have to continue probably cutting. We'd have these disinflationary pressures. There is no growth pickup. Also, the faith in the fiscal spending starts weakening, and you could see the ECB cuts to around 1%. And in that case, the 10-year swap rate would have to follow down quite a bit. We're now at 2.6, but that would start falling below the 2%. On the other hand, if you think about more of an upside scenario, where indeed, as Carsten mentioned, we do have these ECB hikes starting to come through in 2026, maybe even to 2.5 as the new neutral rate in really an upside scenario. In that case, we really see that 10-year swap rate drift higher beyond 3%, and we even have a long-term fair value estimate of around 3.5%. Seems very high, but if you look at a broader history going all the way to the beginning of the Eurozone, 3.5% is definitely something realistic we need to take into consideration.
Yeah, thanks a lot, Michiel. We're almost up for time. Let's just sort of pick out one final question from the chat. Maybe one for you, Carsten. I mean, there's a question specifically about the meeting tomorrow. What do you think Lagarde would reply if asked whether she agrees with Isabel Schnabel that the bar for further cuts is very high? How does she tackle that question?
As a very good politician, stressing again that the ECB is in a good place, that she wouldn't exclude anything, but that she currently feels extremely comfortable in where she is. So I don't think that she would repeat Isabel Schnabel's words, and she would keep all options open. She will sound less hawkish than Isabel Schnabel.
Excellent. Thanks a lot, Carsten. We're out of time. Thank you very much for joining us today. Thanks for all your excellent questions as well. If you want to read a bit more about tomorrow's meeting specifically, you can check out our ECB preview. A link to that should have just popped up for you on the right-hand side. Otherwise, thanks a lot for joining. Due to come along for further events over the next few weeks. Thanks a lot.